Welcome back, dear traders. We are ready to share a red-hot review of US markets, and let's discuss developments, trends, and the forecasts. Wall Street benchmark indexes plunged in light of the Fed's policy decision. This response comes as a no surprise, but Jerome Powell added fuel to the fire. As a result, the major stock indexes closed with sharp losses on Wednesday. The Dow Jones tumbled by more than 500 points or 1.70%. The Nasdaq lost 1.79% and the S&P 500 sank a whopping 1.71% to close at 3,789 points. Wall Street indexes perked up in the New York pre-market, though it's too early for the optimistic forecast. The benchmark indexes traded mixed. The S&P 500 is expected to trade in the corridor between 3,690 and 3,840 points. Market sentiment on Wall Street was in the grips of the Federal Reserve and its crucial decision. All 11 sectors included in the S&P 500 closed in the red. U.S. retailers and utility companies showed the worst performance as their stocks slumped more than 2.3%. The trade volume on the U.S. trading floors was higher than usual, with 11.03 million shares versus the average figure of 10.79 million shares over the last 20 trading days. The reason for market boost is obvious. In a widely expected move, the Federal Reserve announced another rate hike by 75 basis points. The new federal funds rate has increased to 3 and 3.25%. The Fed predicts that the official rate will stand at the level slightly below 4.5%. Recent macroeconomic data suggests that the US Fed could raise interest rates by another 75 basis points at the meeting in November and slow down the pace to 50 basis points in December. Such prospects are extremely bearish for the stock market and the risk appetite. At the press conference, Powell signaled that 2 more rate hikes by 25 basis points could follow at the beginning of 2023. Thus, the federal funds rate could approach 5% annually. The Fed's chairman stated that the policymakers are committed to the battle against the highest inflation in the last 4 decades. The central bank is determined to push ahead until the battle is won. The regulator added that it's unlikely to decrease interest rates until 2024, and such a statement wrecked the hope that the Fed would take inflation under its control in the near future. Goldman Sachs, Barclays, and other investment banks upgraded the forecast for interest rates in the United States in light of such hawkish statements. In this context, futures on the stock indexes are trading quietly today. A fresh weekly update from the Labor Department is slightly higher than the previous one. The number of first-time unemployment claims rose by 5,000 to 213,000 last week, lower than the expected 218,000 applications. Nevertheless, even improvement in the labor market cannot assure the Fed to make a pause in aggressive tightening. Powell's words dampen market sentiment on Wall Street, and the stocks of the top US companies are also affected by risk aversion. Shares of the high-tech giants such as Apple, Tesla, Microsoft, Amazon, and Meta traded mixed in the pre-market. While the stock market is recovering from the post-Fed shock, the US dollar index is taking a breather in its sudden rally, retreating from a new multi-year high of 111.63. Aggressive Powell and mounting global uncertainty encourage growth of the US dollar index, which has conquered the strongest level in the last 2 decades. At the moment of recording this video, the index is trading at 111.08. Its intraday candle is defined between 110.70 and 111.40. And the hawkish Fed pushed major currencies to multi-year lows. The euro plummeted to a 20-year low at 0.9810. And today, most currencies are regaining their footing against the firm US dollar, though they are making minor gains. This week, influential central banks are holding the policy meetings that setting the currency market in motion. The Bank of England raised the key policy rate and stated that it would continue with more resolute measures against inflation if necessary. The regulator is ready to sacrifice economic growth. The Bank of Japan decided to maintain interest rates at around zero to support the fragile economic recovery. A lot of analysts think that such rhetoric is losing its efficiency on the back of the worldwide trend of higher borrowing costs. Following this decision, the yen sharply weakened against the US dollar. Japan's monetary authorities had to intervene on the forex and buy the national currency to stem the yen's free fall. In this context, the US dollar stands tall trading currency pairs. It makes sense to take into account high volatility and the market anxiety. The Canadian dollar weakened to 1.34 against its American rival following the Fed's rate hike. It's at the weakest level since August 2020, and today the USD CAD pair is trading higher at about 1.3488. The outlook for the loonie is bearish. Investors revised their forecast for a new rate hike by the Bank of Canada on the back of the US dollar strength and waning inflation in Canada. Recently, Canada reported that the annual CPI slipped to 7% in August. Thus, inflation eased from its 39-year peak of 8.1% for the two previous months. Despite the hawkish Bank of Canada, there are some arguments to soften the pace of a monetary tightening. Oil prices are also gaining ground today after a slump. The rise is not enough to offset the US dollar's pressure, but growing commodity prices prevent the Canadian dollar from a sharper fall. Today, Brent crude climbed 2.4% to trade at $91.99 a barrel, and WTI futures grew 2.65% to trade at $85.13 a barrel. Apparently, the crypto market was discouraged by the Fed's policy settings. Bitcoin tumbled instantly to $18,126 in line with the opposite correlation with the US dollar index. However, the token recouped some losses later on. Today, the flagship crypto is trading quietly, looking for new fundamentals to support it. At the moment of recording this video, Bitcoin was trading at $18,955 with a faint hope for growth above $19,000. Altcoins are also trading mainly in the red. Bitcoin's intraday candle is between 18,200 and 19,400. And the overall sentiment is obscure among stock investors. Trading instruments have not found the ground for further trends. Make prudent trading decisions with the InstaForex, and see you soon.